bring in our next guest. That's going to be Scott Bauer, CEO of Prosper Trading Academy. Welcome back to the show, Scotty.
Tom, good morning. How are you?
Not too bad. I'm still laughing about Kevin's comments. Free beer tomorrow. Expectations are always there. Scotty, I just wanted to get your take here. We're going to talk about Empire State manufacturing data, but just your take here on the markets. Kevin and Alex Coffey mentioned the slide that we saw at the end of the day on Friday, but, stocks are still at or near all-time highs, but my thought process is that the risk is to the downside at this point. I think we need some consolidation, maybe a slight pullback to kind of support this rally that we've seen. Give me your thoughts here on the equity markets.
I totally agree, Tom, and I would love to see a very slow grind of a 3 to 5% to the downside. Now, the viewers that are watching right now are probably like, "What? Why are you saying that?"
Right.
But I think you and I probably have the same mindset with this. We have really run so quickly here, and I'm not sure why we have, honestly. The ecodata that we've seen out there, yes, it shows a slowing. That's both a good and a bad, though. And I think that at the end of the day, Friday, there were a lot of profit takers because we have just come too far too quickly here. So we don't want to see these big spikes. We don't want to see what happened on Friday. I would love that consolidation like you were talking about, because what that'll do is that will set a base then for a potential next move higher. When you get these big spikes or big drops like this, the market is very unsettled and it doesn't typically trade rationally, if you will, when we see that kind of stuff going on.
Yeah, and I think, I always look at the markets like this, where, you've got nearly 18% gains in the S&P 500 so far this year. This can't keep extending. It can't go in perpetuity just because the valuation of the S&P 500 is 22 times forward-looking PE for next year. I mean, that's expensive on a historical basis. But, Scott, the data kind of supports that dovish narrative. Yields have come off. That's helped support equities. The dollar's pulled back recently. But, who's to say that soft landing narrative can't be, navigated at this point?
It certainly can, but, I think we have to watch out what we wish for. Yeah. The soft data that we've gotten, definitely what the Fed wants to see, definitely what the market wants to see. But you and Kevin were just talking, or Kevin brought up 4.2% on unemployment. If we hit that number, which, I don't know if we're going to or not, next report comes out in a few weeks, that to me would be a warning sign. That to me would be taken very negatively, because even though we've got this soft data, you know what? How much longer can we live with soft data and maybe no growth? So I think we have to watch out what we're wishing for.
Yeah, it's almost like, downbeat data has been positive for markets. When does that turn when downbeat data means,
exactly,
hey, maybe the economy is cracking a little bit? We've already seen it in a bunch of consumer names that they're still under pressure. Pepsi was a good example last week post-earnings, even though it did rebound. It's still, down on the year. Let's see, New York Fed manufacturing came in at minus 6.6 on the Empire State. Forecast was about minus 8 or so previous. So it basically came in just a little bit better than expected. But Scott, is that reflective of the manufacturing side of the economy at this point, where it's still underperforming and services continues to outperform?
Absolutely. And I don't think we've had a positive number since, if I'm correct, since last November, whether it's minus 4, minus 8, whatever it is. So, yeah, manufacturing still is under pressure. We're seeing this weaker data here. And again, I know that the market wanted to see this, Tom, and we've seen rates come off, though I think the 10-year is ticking a little bit higher right now. I'm just really concerned that we're getting too weak too quickly here. The Fed hasn't reacted to that because they look at data that is in the rearview mirror rather than, kind of projecting out into the future. So I'm with you. I think we need to take off a little bit from the marketplace here. VIX is still incredibly inexpensive. I know it's up a couple bips this morning, but it is still incredibly inexpensive here. I'm telling my students and the people that follow me, you got to buy it when you can and not when you have to.
Yeah, the complacency I talked about with Kevin and Alex, as far as markets go. There's a little bit of complacency out there, and just what happened over the weekend with the assassination attempt. There's a black swan events out there that could definitely affect markets. But Scotty, if you look at the expectations of those rate cuts continue to move higher for September. To that point, should the market be careful what it wishes for, because they want rate cuts? There was 6 expected at the start of the year. We kind of laughed that one off. But now they're starting to ramp up that rhetoric again, and PPI data kind of reflective of, if that starts flowing in CPI data, we're not going to get any more weak numbers there, and you got crude oil back around $82 a barrel.
No doubt about it. There's still so much ecodata, important ecodata, to come out before that September meeting. So, I don't think anything is baked in at this point. I know you were talking CME FedWatch tool now well above 90% for that September cut, but we've got to watch this data. I mean, that's what the Fed is going to do. I really think that they should cut in July and then kind of see what happens. That's not going to happen. There's almost zero chance of that happening. But again, my concern with them is that everything they're looking at data-wise, data dependency, is in the rearview mirror, not looking forward.
Yeah, that CME FedWatch tool over 90% at this point. And then you start throwing politics in there. Do they cut in September? Or is July the better alternative, where it's still, 5 months out from the election at this point? Real quick, Scotty, just what you're looking for moving forward. There's not a lot of, maybe market-moving data this week, but earnings start to ramp up.
Yep, earnings are ramping up. We saw kind of a mixed bag out of the banks so far. Goldman had a good report this morning, but it's earnings season right now. 2 weeks away is the Fed meeting, and also that jobs report 2 weeks from Friday. So, we may get a little bit of complacency here, but again, Tom, I would not mind seeing just a slow grind to the downside. 3 to 5%, I think, would put us in a really good position.
Yeah. Pullbacks aren't unhealthy, Scott. And,
Nope.
You and I have been doing this a long time, and we see markets get overextended quite a few times. But, great stuff. As always, Scotty, appreciate it. Have a great day.
Great seeing you, Tom.
Yep, you too. That's Scott Bauer, CEO of Prosper Trading Academy.